All right. Hey, guys. Welcome back to Ask a CPA podcast. I am here with the one and only Russell Wallace. What's up, Russell? How you doing, man?
Doing well. I'm doing well. How about yourself there, Brett?
Man, I'm doing great. Been a good weekend. Just kind of hung out. I'm over the flu. I had the flu last week. Just
Oh,
went through our
man.
whole family and, man, yeah, really beat us down, but I am pumped up to be feeling better. Yeah, been working on my short-term rental all weekend, getting like the things all set up and ready to go
Yeah.
for this summer. So I've already gotten a few people on the books, which is good.
Well, it's probably
Really,
pretty motivating now that that property tax payment was due here
yeah,
recently.
yeah. I'm really trying to get it as profitable as I can this year. Last year we had a bunch of capital improvements that we had to do to the building, so that really ate all the cash out of the business. So this year I'm really trying to focus on profitability and getting this thing up and running. So we'll see. Hopefully it's a good year.
Yeah. Well, it's a good example of short-term rentals that can be profitable. They can have kind of a lot of like family intrinsic values, a place to go vacation every year. But most of the time, passive real estate is not passive, and that's just something we talk to our clients about a lot.
Yeah, it's not we had like our outdoor furniture all fell apart, so I had to order new outdoor furniture, and we don't live there. So we live in Dallas, which is like 12 hours from where our condo is. So I'm gonna drive down there. I think maybe Friday. I'm just gonna just schedule a bunch of calls all day and just drive and just drive and take calls all day
There you
and
go.
bring it down there, put it all together, and then jump back in the car and drive back.
An efficiency machine.
Yeah, we'll see. We'll see. Well, cool. Well, today we got a couple questions. We got a lot of activity on the podcast the past couple weeks, so we're really excited. Everyone's been reaching out and emailing through our website at askacpa.co, and they've been submitting questions and liking and following along through YouTube, which is fantastic. So if you're new to Ask a CPA, make sure to subscribe and hit those like buttons and ask questions. We really encourage people to jump on and engage, and we'll certainly, respond as quickly as possible. Have you gone on and looked at some of the comments and activity on there? It's pretty cool.
Yeah, no, it's great. It's great. It's hard to watch yourself, but so I try not to do that too much. But I love reading the comments and the feedback. It's great.
Yeah, absolutely. So our first question today comes from Mark in Dallas, Texas. Our hometown. Maybe we know this guy. Mark asked, my father passed away last year and I inherited some money, a house and an IRA with about 250,000. Do I have to pay taxes on these funds? Well, this is quite the loaded question here. There's a few different things. And there's been some recent tax law changes as well regarding inherited IRAs. So let's kind of go through them step by step. So one is cash. Cash is easy. It's non-taxable, assuming the estate is under the estate threshold of about, it's like $13.5 million right now, and everyone thinks that the Trump administration is going to extend that or increase that limit. So yeah, just cash. If it's under that threshold, it's fine, no problem. That's not non-taxable, and you can just put that money in your account, spend it, or hopefully save it, and yeah, you don't have to pay tax on that. The house is a little bit different, so you'll get a step up in basis to the fair market value of that house on his date of death. So if he passed away on September 15th, you just want to go out, determine what the fair market value of that home is on September 15th. You can do that by having an appraisal done or by talking to a real estate agent and having them, run some comps and kind of seeing what the fair market value is. And then if you sell the property, now you have this step up in basis. So hopefully the gain or loss on the sale of that property is minimal. If you hold it and continue to rent it out or live there, then whenever you go to sell it, you'll want to know what your basis is or what the fair market value was on that date. So it is important that you determine what the market value is on that date. So then whenever you do end up selling the property, you have a good documentation for fair market value. So that's the money in the house. Those are kind of easy ones. The inherited IRA is kind of a tricky question that Mark has here. So the rules recently changed with inherited IRA. And first you have to look at who you receive those funds from. So in this case, Mark's father, who passed away, if he was already taking required minimum distributions or RMDs, then you're required to continue to take those RMDs over the next 10 years until you fully take all those funds out of that retirement account. So you have to work with a financial advisor or the financial institution in which you and whoever's holding these funds. They'll usually tell you, they'll calculate what the RMD is for that year, and then they'll tell you, hey, you have to take out $15,000 this year. And you can take out more than that, but you at least have to take out that $15,000. It could be any number. I'm just totally making that number up. And you have 10 years to take that out. If he wasn't taking RMDs, then you're not required to continue or start taking RMDs, but you still have 10 years to take all that money out of the account. So you could either take it out, 1/10 every year. You could wait till year 10, take it all out. You could take it all out in year 1, as long as it's fully, until all the funds are fully taken out of that retirement account, you have 10 years. So you can choose how to pull those funds out, but they do have to be all taken out within 10 years. Yeah. So those are kind of the loose rules on those. Certainly work with a financial advisor, work with your CPA to determine what the best tax strategy is. So you probably don't want to take it all out in 1 year, because you're going to get hammered with taxes on that. So, work with a financial professional and make sure that you have a plan in place and that you execute on that. Have you seen a lot of these, Russell?
Yeah, they come up from time to time, and it's great that there's kind of a legacy left, by parents or uncles or other family members, and so that's kind of really cool. And you mentioned the step up in basis, so that's a huge one on the property. And what I generally tell clients that come to me and ask me about this is that if the house has a substantial value, and especially if the cost basis is either the original cost basis from the parents is was purchased so long ago you don't know, or it was really really low, that sort of thing, then I always tell them, look, it's just worth the $600 or so. Get an appraisal, get that kind of line drawn in the sand of where that basis, or where that new basis, that step up in basis is at the time of death, and or the time of that you inherited it, and that way there's just never any question about it, right? So if this is a $600,000, $700,000, $800,000 property or more, it's definitely worth, and you're going to hold on to it, right? Then it's definitely worth that appraisal. Now, if your plan is to sell it, if you just inherit it and then you kind of clean it up or fix it up and put it on the market and sell it, don't waste your money, right? The value and the inherited value, or the value when you inherited it, it's probably just the same, right? So you're not going to owe any taxes on it. But if you're going to hold on to it and it's substantial value, invest the money, get the appraisal. I call it sleep insurance. This was one of those things that you just don't have to think about it anymore, right? So you got a little sleep insurance to keep there in the file. And you mentioned on the retirement account, the IRA, and I think this is really smart that you're thinking about this, and that is that kind of staging those withdrawals for spreading them out so that you're not getting this money in the top tax bracket. That's especially true if you're on the kind of the borderline for your family, where a little bit more money, and all of a sudden now your tax rate on all of that money that you're pulling out is going to be taxed at, the ordinary income rates anyway are going to be taxed, 6 or 8% higher. Then that's where you really want to think about, hey, how do I stay under that bracket so that next dollar isn't taxed so high? And if you have the ability to do so, like you don't need the money right now, that sort of thing, that's really smart to do. And if you're already retired when you inherit this money, that's especially true where you probably have some down years in income anyway. And so using those down years to pull more of that money out so that you can still achieve pulling out in that 10 years, but then having a little bit of a plan is just going to help stretch that money a little bit longer. So that's where a CPA can add a lot of value, as well as a financial advisor is too, right? Can add a lot of, especially when the CPA and financial advisor are working together, really, it can add a lot of value to the situation.
Right. Yeah, that's a great point, especially if you're still in your earning income years, but you're thinking, hey, I'm going to retire in 5 years. Well, then don't pull that money out while you're still making an income, and just wait until you retire, and then start to draw down on those funds while you're in retirement at a much lower tax bracket.
That's right. And most investments are available no matter where your account's being held, right? So if you have accounts at Schwab and this is at Fidelity, that's sort of, you know what I mean? Like this, they're all going to be same account, the same investments are going to be available. So you can just leave it there in the account and not have to worry about it.
Yeah.
That's great. Yeah. Well, we've got another question here. That was a good one. And looks like we're going to have kind of a retirement theme here. But we've got Robert in Nashville. It's got a good question here. My accountant suggested I make a last-minute SEP IRA contribution to reduce my taxable income. How do I calculate the maximum I can contribute, and what are the deadlines? So I love this. You know, anytime I can put money away into an account and reduce my taxable income, you know, so it's like an immediate, depending on your tax bracket, right? Let's just say you've got 30% tax brackets, immediate 30% jump in your investment portfolio, though, because that 30% would have gone to the government. So I like this a lot. We utilize this. I have utilized this in our firm before, and always tell my clients, especially if they're a solopreneur kind of class. I don't have any other employees, but you have to be careful about that. So anything you do for you, you've got to do for everybody, right? And so keep that in mind. But 25% of your taxable income, so your active taxable income, you can put away into the SEP IRA. And so you have until you file the business tax return or your personal return if you're a Schedule C filer. So you have till 3/15 or 4/15 to make this contribution, and it's effective for last year. So you can get all the way done with your tax return. This is what we do with our clients. We get all the way done with the tax return, and then we just see where we're going to have the biggest benefit by contributing that money. And then, you know, based just like we were talking here about Mark's question, look at those tax rates when you have that kind of step up. So when those marginal dollars are a little bit more expensive to have to keep, then, you know, kind of getting getting that taxable income below those thresholds, making that contribution, and kind of getting the most out of that as we can. But I love the fact that you can do all of that planning and then decide how much you're going to contribute. So you don't have to kind of pre-plan like you do with a solo 401k, some of these other ones, you have to, the employee contribution side of things, right? You've got to kind of make those contributions before you know exactly what those tax rates are going to be, exactly what that outlook is going to look like. So here, you get to get completely done and then make that decision. So I love these things. So what about you, Brett? You like these as well?
I love them. Yeah, I love any kind of retirement plan. You know, it's especially important for entrepreneurs who, you know, you're taking a lot of risk by starting a business. Most businesses, you know, fail within the first 5 years. It's an ungodly high number. So if you're taking that risk, you should really make sure that you're taking control of your future as well, and making sure that you're putting money aside for your eventual retirement. I know a lot of people, you know, have the majority of their net worth inside of their businesses, which can be a little bit scary. So, you know, having that retirement, that kind of traditional retirement account on the side where you're kind of, you know, setting aside some funds for the future, can be important. I know I'm kind of in the same position where it's like, you know, if I look at my net worth as a whole, my business takes up a big portion of
a little
that.
scary.
Yeah, of that pie. So yeah, it's important to have those retirement accounts and put them aside. And yeah, and there's a lot of options. So a SEP is great, especially if if you need to set it up and execute it in the same year. If you haven't really done any planning, a SEP's great. I really like a solo 401k as well. It just gives you a little more flexibility on the contribution amounts. You're not capped at that 25%. But yeah, I think, or, you know, if you have employees, obviously a 401k or a simple plan are great as well. When we started our business, we set up a simple, which is great. It is simple. You know, each employee has their own kind of plan, and you're just contributing to it. There's no vesting schedules. There's no complications. There's no testing or anything. It's real simple. And then we eventually moved over to our 401k because we just wanted to increase the contribution limits and add a little more complexity to the plan. But yeah, I think that's huge. That's a great question, Robert. And do it.
Yeah.
Fund that.
Well, you made a good point there about solo 401k being a great option, and in some ways allowing some more flexibility in the contribution amount. So this is where the SEP is great because you can have this kind of after the fact planning, you know, up to the 25% of your taxable income. But if you're an S corp owner and you're maximizing the tax benefits there by making sure that your salary is just what a reasonable salary would be, then you may want to contribute more than that 25% number. And the solo 401k allows you to do that. You just have to do it at that employee or the employee contribution side of it just has to happen in the taxable year, right? So you can't do this after the fact contribution in that case. So it makes it a little bit more difficult from a planning standpoint, but that's why people come and talk to us.
That's right. That's right. That's why you make the big bucks.
That's it.
Well, cool, man. This was a great episode. We had a couple questions. One from Mark in Dallas, where he had an inherited IRA and inherited money in a house. Then we had Robert from Nashville, Tennessee, where he wants to contribute to a SEP IRA. Those are both really good questions, and we appreciate them reaching out. And make sure that if you found this episode helpful, that you make sure that you subscribe and hit that like button and share it with some friends. If you have anybody that that's a business owner or needs some accounting or tax help, shoot us an email or make a comment or share it with your friends, and we appreciate all the feedback. And we'll see you on the next episode, Russell. This was great, man.
Yeah, this is good. Keep those questions coming, guys. Talk to y'all soon.
That's right. All right. See ya.